To start off the summit, we have a real trailblazer. And you have to be a trailblazer to get to the top of any mountain, any summit. So Mark Yusko is going to start us off today, and he's the CEO of Morgan Creek Capital Management. And the topic that Mark is going to be covering is King Dollar could be dethroned. How close are we to a Bretton Woods moment? Welcome to the summit, Mark. Thank you so much for taking time out of your day to be with us.
Thanks, Dale. Thanks for having me. Hey, Steve, how's everybody doing?
Hey, Mark. I'm good. How have you been? Nice to see you here.
Great to have you.
Good.
So, Mark, we've been talking for a while, and your take on what's been happening in the financial markets was basically a move away from the dollar. I know you've been very constructive on Asia. You're a China bull, so what a great topic. In fact, what was the year, Mark, of Bretton Woods? What year was that?
44, right? 1944?
1944. And when we came off it during Nixon.
August, if I remember right, August of 71.
1971, yeah.
Yeah, I think it was August.
Okay, so you know what? I was a freshman in college. That's how long ago it was. And, I had no idea that we had come off, any kind of metal standard. And I do remember, though, there were these buttons called Whip Inflation Now. You're younger than me. Do you remember that era at all, Mark?
Absolutely. I'm not that much younger.
So
I'm younger, but not that.
Yeah, I know. So, who isn't? And so this is going to be a great topic because, there's been a lot of talk about, and I'm sure the world's looking at what we're doing in this rescue package of, because we are the reserve currency, having the advantage of being able to print trillions and come up with trillions for this and that. It's almost real money now. And I'm sure there are many people saying, well, do we want to hold this kind of paper? So without further ado, Mark, why don't you tell us what you're thinking in here about the possibility of another Bretton Woods moment?
All right, sounds good. Do you guys want me to use video or just audio?
Well,
absolutely, Mark. It's our pleasure if you want to share your camera. Absolutely.
Yeah.
It's just, I think you guys have to.
Yeah. My mistake. That's my mistake. There you go.
I'm perfectly happy for no one to see.
There you go. Sorry, my mistake.
Okay.
Face. But all right.
All right. There's Mark.
There you go. Nice to see you.
Good morning, everybody.
Good morning.
All right. So what I'm going to try to do, and I'm not sure if this is going to work, but let's see. I'm going to try to share screen.
Beautiful.
Oh, look at
you
that.
Got it.
It did work.
Beautiful.
Right. So what I'm going to do is I'm going to go through some slides that kind of lay the groundwork for the conversation, and then we can take questions as you guys have them. But I like these quotes on just doing this generally, right? Making predictions is hard, especially about the future. Financial markets are generally unpredictable. And so to actually predict makes less sense than going through scenarios. And I thought you guys were doing a good job of that before we started here, talking about different scenarios and looking at the way the market might react. One thing that I really try to focus on generally is this idea that markets are in a constant state of uncertainty and flux, and you make your money by discounting the obvious and betting on the unexpected, so betting on surprises. And then Lao Tzu, I think, is my favorite. Those who have knowledge don't predict. Those who predict don't have knowledge. So we'll see which ones you guys think I am as we get going here. So when we think about this idea of global reserve currencies, for many, many years, right, for hundreds of years, that global reserve currency was created or given to the country with the best navy, the fastest ships. And you go all the way back to Portugal. I mean, who would think that Portugal had the world reserve currency? But they had the tallest trees, therefore they had the fastest ships. And then they got taken over by Spain, so they had the tallest trees, fastest ships. Then the Netherlands took over, then France, then the UK got the steamship, and they became the most powerful until America got nuclear power and the nuclear subs and aircraft carriers and all that good stuff. So here we are today. And what I love about this chart is it says in 2030, which is actually only a decade away, the U.S. loses world reserve currency status, and we end up with this global, and I think it's interesting that it goes global, and we'll get to why I think part of that will be about Bitcoin, and we'll get to that here in a little bit. So if you think about money, when we think about trading money, one of the things that's interesting is if you put all the money into perspective, all the money in the world, 86 trillion, again with a T. Then you got physical money, about 31 trillion. And then gold at 8 trillion. Now, this is interesting. Gold actually is the biggest currency. Now, not all of that 8 trillion is monetary. It's probably about 2 trillion. And, the US dollar is only about 1.5 trillion. So even though people think of the dollar as being king, it's really gold when it comes to currencies. Now, king dollar does have the highest exchange traded volume in terms of the amount of money that's held in reserves around the world. But what's interesting on the right-hand side is the renminbi now is part of the IMF SDR. And that's really important when people think about, global supremacy and who's going to win in terms of this global currency regime that we're in. So I talk about these surprises, and one of my surprises was that, despite the fact that the Fed kept calling it not QE, now they are calling it QE again, and they've bought more in the past 4 weeks than they did in all of QE1. The problem is that interest rates that everybody thinks have to go back up keep going down. Now, why do they keep going down? It's the chart on the left that talks about this chart of truth or line of truth, that every time interest rates in the U.S. get to this line of truth that's been declining for 30 years, we have a breakdown. And that happened back in 2018. Coming into this year, we had this big wedge on the left-hand side that basically told us that long bonds were looking more attractive than stocks. Now, long bonds have outperformed stocks this year pretty dramatically, up quite nicely versus down. So 30+% increase. Now, what I think is really interesting is how, actually, I'm sorry, the last chart was since 2018 when this all started. Really this year, look at the 30-year treasury on the left-hand side, sub 1%. Now, then you see that big rising line, that spike up. What that was literally is the treasury market broke. Sunday night, sitting at home on Twitter as I usually am at night, and a friend calls up and said, "Hey, you're still up?" I'm like, "Yeah." She says, "Can you talk?" I'm like, "Sure." She says, "I just heard from a friend of mine at Treasury that the treasury market has broken. Literally, they're not settling trades." And so we went from sub 1%, almost back to 2%, almost overnight.
Never saw that happen before, Mark. This kind of volatility. Yeah.
And look at the trend since, right? And I'll talk about this a lot, is my friend Larry Tentarelli says all the time, nothing good happens below the 200-day moving average. And the surprise in a trend goes in the direction of where you are relative to that 200-day. So the surprises in the treasury market continue to be negative. So we think the interest rate trends continue to be down. We think the bond bears that keep coming out of the woodwork are going to be wrong, and that you should really focus on this long-term trend and move in the, I'm going to move this over to the other side for a second, and that, even the long bond here, the 30-year as well as the 10-year, we think is going to continue to be a good place to invest. All right. So surprise number 2 was that we would have a recession. And as of this morning, we are definitely in recession in the U.S. And it has to do with these 4 horsemen. And it really goes down to what I call the killer Ds. So demographics, every day 10,000 people turn 65, both in the U.S. and in Europe. And what that means is this global tidal wave of an aged population. And, it's like the old line, gentlemen prefer bonds. Older people, 65 to 85-year-old people, prefer bonds. And the demand is going to push interest rates globally to NIRP, negative interest rates, all around the world. And it's really because of this problem with debt. So the second killer D is debt. So you got bad demographics and you have too much debt. And we've printed 16 trillion with a T. And again, nobody talks about the trillion word the right way. A trillion is a dollar every second for 31,710 years. And so you've got this problem where we've created this illusion of growth, and it's fake growth. I call it fakeonomics. So we've got fake growth created by debt, and that's causing the stress. And everyone talks about the rise of inflation. We're going to have hyperinflation. Well, we have no inflation anywhere except in emerging markets. In places like Venezuela, Zimbabwe, we got hyperinflation. Why? Because they don't have high productivity levels. And when you print money without latent productivity, you get hyperinflation. In the developed world, we have lots of productivity, lots of latent productivity. We got low productivity levels because we got rising bad demographics. And yet we've got deflation everywhere. Japan leads, then Europe, then the United States. And that's going to stay for a while. So copper, we have to watch copper. Dr. Copper is out of ICU, but still on oxygen. On the right-hand side, we have a little rebound in copper. But we think it's going to continue to be negative, and particularly when second quarter GDP growth comes out, which can be really bad, could be down 40%.
He was sued last year, Mark, Dr. Copper.
Yeah.
For malpractice for impersonating a bull market.
Oh, that's awesome. I love it. And the second of the four horsemen, so the four horsemen are Dr. Copper, 10-year rates, oil prices, and the Kospi. And 2-year or 10-year rates, we had no idea that it would get this bad this fast, right? That we hit 0.5% on the 10-year. Treasury market broke, as we talked about, but it's still ugly, right? We're pressing down at 0.6% this morning. We're pressing down at those all-time lows, and we think that's going to continue. Oil prices, look, we thought that oil prices would fall as economic weakness went up, but we had no idea, no idea that we'd get negative $37 like we saw at the futures roll the other day. So what's really interesting is the market is not buying, I call him the tweeter-in-chief. The tweeter-in-chief's nonsense about he brokered a deal with Saudi and Russia, clearly just not the case. And even if he did, they don't have the firepower to fix the problem. But it's actually worse than that. Oop, I went too far. Kospi actually does believe in QE. So you can see tech stocks have been rallying quite nicely, and Kospi regained the 50-day on the right-hand side. So that is an interesting development and something that people should at least pay attention to a little bit. Although I think, the sales, Apple has basically said they're not going to ship phones at the end of second quarter, which I think is amazing because there's just no demand. So the other one was we believe that pigs get slaughtered, in the sense that people were sticking around the Fang Man too much. And we warned back in January that it was starting to look just like 2000. You can see March 10th, 2000. We called this, tech bubble 2.0. We thought that things were going to get ugly. Again, we didn't realize how ugly they were going to get in March. What's really wild, on the left-hand side, you can see the red lines going down, which is retail investors actually fled stocks faster than any time in history. And just let that sink in for a second. Worse than 2008, worse than 2000, worse than 74. The biggest sale, and human beings do two things really well. We buy what we wish we would have bought, right? So we're plowing into stocks in January and February. And then we sell what we're about to need. So we sell at the bottom. So we bought at the top, sold at the bottom. Now someone is buying futures. On the right-hand side, we see that spike up in the blue line. That is a crazy, crazy increase in buying of futures. Now, who's doing it? Well, I think we have the answer now, is the Fed used to not be able to buy corporate bonds. They used to not be able to buy high-yield bonds. They used to not be able to buy stocks. It was against the law. Well, how did they get around it? Well, they've set up these special purpose vehicles with Treasury. The Treasury issues bonds, and they buy the bonds, and then Treasury does the dirty work. So I think we're seeing this futures volume driving the big cap stocks, which is why we're getting so much concentration in FANG, and you're not getting any follow through in the rest of the market, which is kind of scary. So everything's fine, right?
So Mark, do you believe you are a believer in a plunge protection team, and this is how they're executing?
Absolutely. The plunge protection team is fact, right? It's not conspiracy theory. It's fact. It was created first quarter of 1988. It's called the Council on Economic Stability. It's made up of the Secretary of the Treasury, the head of the Fed, the president of the four biggest banks at the time. It was Salomon Brothers, JP Morgan, Citi, Solly turned into Citi, Morgan Stanley, and Goldman Sachs.
Okay. So but other than that, the Fed is independent, right?
Oh, of course it's independent. Of course it's independent. And you can see that in the jawboning reaction. Although it's never been independent. It's interesting. Everyone says, oh, Trump's the first one to pick on his Federal Reserve chairman and make him do what he wanted. No, Nixon did it, and Johnson did it, and everybody did it.
Yeah.
So you just have to be old enough, again, like us, Dale, to have seen the history. So what I think is really interesting and scary at the same time is these 5 stocks, right? Facebook, Amazon, Apple, Microsoft, and Google are now the majority of the market. In fact, it really should be renamed the Fab 5 or the S&P 5. And we have a concentration risk on the right-hand side that we've never seen, right? The Fab 4, Microsoft, Cisco, Intel, GE, actually Fab 5 back then, they included Walmart. That Fab 5 got up to 18%. We're at 22%, a level, again, that we've just never seen. And when you look at that chart on the right, you'd say to yourself, I've seen that chart somewhere before. Well, it looks exactly like the famous bubble chart. And that's the new paradigm. And then we have the fall, which we did. And then we get a return to normal, the bull trap. And then you get, the fear and capitulation on the other side, and you get the crash. Because it doesn't, you notice you don't go to these levels and then plateau. You peak, and then you spike, and then you fall. And here's something that I just find so frustrating, right? Is people are saying, oh, well, we're back in a bull market. Well, bull markets start from valuations of 40% lower. So you can see the rising green line, that is fair value. The blue line always goes back and touches fair value before a new bull market starts, except this time. So we went down 34%, but now we're only down about 13%. And we've got a long way to go to get to fair value. Expected returns in that green box, basically saying that, at the bottom, we actually had a chance to make some positive returns in stocks over the next 4 years or over the next 10 years. Now we're back to zero. We have expected return for the next 10 years of zero. So look, don't fight the Fed. It's hard to argue with this chart. You guys are much better on charts than I am, but the only negative I would see on here is the 50-day, looking towards a death cross, but people say death crosses don't matter. I would say that maybe you could say there's a little bit of an attempt at a shooting star on the far right, but we'll see, or a double top or whatever you want to call them. Although I don't think double tops is even a thing, right? It's double bottoms. Make volatility great again. This is one of my favorites. We thought volatility was the cheapest asset class on the planet coming into this year. Nobody wanted to own it. Everyone was selling vol. And this is a really important chart. Now, people think I'm crazy when I start talking about this stuff, but this is a guy, W.D. Gann. He was a forecaster and trader back at the turn of the century. And he had found this book by Samuel Benner that Benner wrote in 1860s about commodity trading. And Benner laid out the chart on the bottom, basically predicting every market peak and market trough for the next 150 years. Now, this was done, remember, in the 1800s, published in 1901. This guy was pretty freaking good, right? He got the top in 29. He got the top in 37. He got the top in 73. He got the top in 91. He got the top in 2000. And he was saying that 2018 was the next top, and that now this year, 2020, would be a panic year. One might argue that we had some panic. And what's really interesting is he says you also have to watch for these lunar days around March 21st, June 22nd, September 22nd, December 22nd. The big change off the bottom was literally on March 23rd. right near March 21st. So really interesting how patterns repeat, and it's because human beings are driven by these cycles.
We have
So
one coming up, Mark, I believe early May, a
yes.
supermoon.
Yep, exactly.
First week of May.
Well, here's a crazy stat. You guys will love this. So over the last 100 years, if you bought and held, you made about 23 times your money. But if you bought the new moon and sold the full moon, so you're only invested half the time, you're invested for 2 weeks out of every month, you actually made 14 times more. Not 14% more, but 14x more. Pretty interesting. So volatility was really, really compressed coming into this year. In fact, it reached levels of contraction that we had never seen in history. Anytime you're using words like never and ever, it's usually pretty bad. And there was no volatility anywhere. And we said, look, when there's no volatility anywhere, when it arises, it will get ugly. And what was really concerning, and you guys, again, follow this more than I do, but if you look on the right-hand side, the futures market in VIX, in volatility, really was worried about this election. So you can see the volatility was really low on the front month, but out 10, 11 months, it was all the way at 20 back in January. So the fact that we went to 80 something, all right, and we had a record volatility smash, right? 23 days, plus or minus 3% over the past 7 weeks. Now it's so funny. Everybody's looking at the green lines. You can see the green lines. Everybody's saying, oh, well, this is a bottom because the last 2 times we had that kind of volatility in October 32 and November 08, we had big equity rallies. Well, why are they ignoring the 2 red lines on the far left? That seems odd to me because that was in 29 and 30. And I'll argue we're right in the middle of 1930 and it's about to get really ugly. So
Mark, can I just interject for a second? Before the coronavirus, we were already in a manufacturing recession. And people seem to forget that, right?
Yep.
And so now because you can blame everything on the lockdown, but we're already having problems with manufacturing. The consumer was holding up this economy, 70% to 90%, some people say, of the economy. How can the consumer recover from this?
Well, I mean, they can't.
That's what I thought.
Well, they can't, right? Now,
yeah.
What's interesting is some of them can, right? Those of us on a salary, okay, we can. Now, even we on a salary aren't spending as much as we were because, we can't go out to eat as much or ever at all.
Or want to go.
And the want is going to be, but even the want is going to be a problem. So a friend of mine's in the restaurant biz, and he was just informed by the governor that when he's allowed to reopen, I think in 3 weeks, 2 weeks maybe, he's only allowed to have 25% of capacity.
Yeah. And
then it phases to 50 and then 75, but he's not going to get back to full capacity for a very long time. Now, the problem is at 25% of capacity, he's done, right? He'll be out of business. And that's going to be true of many, many restaurants. Right. And so we're killing off businesses, particularly retail businesses, for what looks like dubious reasons. And we don't need to go into the whole conspiracy theory, but actually I don't even think it's conspiracy.
And then you have things like the LA Lakers getting loans that were meant for different types of organizations. I don't think NBA teams needed this emergency loan.
Look, the graft and corruption in the doling out of trillions of dollars is really crazy. Look, there's no reason you would fire the inspector general that was to oversee the handing out of the money unless you were planning on doing bad stuff, right? You don't fire the guy who's looking it over. So bad stuff's going to happen. It's already happening, and we're seeing that. Dale, to your point, here's an interesting chart that goes exactly to your point is not only have we been kind of in this recession that people don't like to talk about, but the market's been dead money for 2 years, right? We had Volmageddon back in February of 2018. Then we had the Khashoggi crash, and now we've got the Corona crash. And, I think as people think about, where we are, they're going to start to get a little more nervous And there is a way to protect yourself, right? You can buy these things, VXX and TVIX, whether you want to be unlevered or levered. And back in first quarter 18, you made a lot of money when the market was down. Fourth quarter 2018, you made a lot of money when the market went down. But this time, it was unbelievable, right? VXX up 360%, with the S&P down 30, and TVIX up 1,450%. Now, I wouldn't buy them here, which I wanted to talk about. It's not quite time to reload VXX and TVIX, but the risk reward is rising every day. And that little doji yesterday is kind of got me maybe starting to be interested. I'd love to see a nice hammer here, but at least there's some chance that the risk reward is getting better to buy VIX. So let's get back to currencies. Look, wars have no winners. Currency wars are a bad idea. Now, the dollar, back to Steve's point, since 1971 has been in secular decline. We went off the gold standard, went on the oil standard, de facto oil standard. We cut a deal with Saudi and said, we'll protect you as long as you price all global oil transactions in dollars. So we went off the gold standard, onto the oil standard, because you have to be backed by something in order to be global world reserve currency. Now, the problem is that everyone wants to believe that the dollar is going to be strong. Now, it's only strong because the other big currencies are getting destroyed. So, Lagarde has picked up right where, Draghi, whatever it takes, has done. And so she's now destroyed the euro even more. Kuroda-san, right, he just laughs about it, right? He only has one job, which is to weaken the yen. So he presses control print every single day. So back to this issue of where are the currencies. Again, look at the renminbi quietly sneaking up on the Eurozone and eventually going to overtake the dollar, I think, for one of global reserve currencies. So we're in a currency war. That's a bad thing. Probably is going to make the financial crisis worse because countries are at war. This is another important thing that people don't talk about is if we called sanctions, right, starving kids, it would sound a lot less good. And we've weaponized the US dollar in order to, propagate certain geopolitical ideals, and that's interesting. So how do you win a currency war? You swap paper for sound money. Now, what's sound money? Well, gold has been sound money for 5,000 years, and that's been the most sound money. But I'll argue Bitcoin as digital gold is going to be for the next 5,000 years. But you can see Russia and China have been accumulating gold and giving us back our paper, and that's how you win the war. So WEF said that digital currencies could end the global currency wars. And I hate to quote Ricky Bobby, but if you ain't first, you're last. So whoever is first in creating a digital currency is going to win this war, and it's going to be China. So fundamentals are good for this secular dollar downtrend. Elliott Wave says that dollar's going lower. But look, there are a lot of people on the other side. So Fidelity is on the side of the dollar being weaker, and I didn't draw the triangle on the right-hand side, but that's not a great pattern. Although you could say if it broke out over 103, that would be a good upside. But there are people that think this is the biggest cup and handle in a long time. So I could be convinced that if the dollar DXY could break above 103, that could be interesting. Oil, all shale that ends shale. Look, Saudi Arabia declared war on U.S. oil on March 7th. And how did they do that? They basically said, we're going to force you to stop this madness. So the U.S. shale business had been pouring money into the ground and taking out oil. Now, they were losing their ass. They lost over $650 billion wasted, gone, negative free cash flow. And now the government wants to buy oil companies. That's even stupider. So here's what Saudi did. Saudi said, look, we're going to increase production by 2 million barrels a day because Russia's not complying with the cuts. And
after they got their IPO off, Mark.
Of course, because they're trying to defend it.
Yeah, they first wanted to get Aramco off the door. And then
exactly. Find some backholders and then start the war. No, they are very crafty because here's what's really scary.
they have sent, so not only did they, basically hand off a bomb to anybody who bought the IPO of Aramco, and a lot of them did it on leverage, which is even crazier. So now they're way underwater. But what they've done is they basically sent an oil bomb to the United States. There's 50 million barrels in floating storage coming to U.S. to fill up storage in the U.S., which is why we got the negative prices in last month or this month. So here's the problem. Under $30, basically shale is done. U.S. shale companies go out of business. Demand is not going to fix it because 40% of demand goes into cars and trucks. Cars and trucks aren't driving now. Gasoline demand in the U.S. is down 85%. So we've had the worst oil performance ever, which is kind of crazy. Ever, again, is a bad word. And energy credit spreads have blown out. Now, look, I look at this, WTI chart. Nothing good happens below the 200-day. Now, you could argue that, we just had a hammer thrown down with a nice long wick down to 10-10. Maybe. It is a double bottom, arguably, on lower volume. So maybe that's a good thing. I do think oil is going to go back up. I just think it's going to take time. Energy stocks, on the other hand, look, we didn't think it could get any uglier. It did. It got really, really ugly, but it looks to have made a really nice bottom here and just took the 50-day. So we're actually a little bit bullish on some of the oil stocks. There's still a whole bunch of oil stocks that are going to zero.
Just bought in the morning TOT, so tell me that's one of them.
Yes, exactly. Well, Saudis, buy the ones that the Saudis buy because they're usually pretty smart. So I'm not going to talk too much about Japan. Japan is good at one thing. They're good at printing money. And it hasn't helped their stock market. The stock market's basically been flat, but man, they are really, really good at printing money. But the problem is the yen, Kuroda-san needs the yen to go down. He needs 115, 120, 125. The problem is the rest of the world still views the yen as a safe haven. I don't get that part, right? Government at 200% debt to GDP. I don't really understand, but I guess there's a lot of people that finance macro trades with yen, and
Mark, I think part of it has to do with the fact that Japan, a lot of its debt is internal, so the rest of the world thinks that their external debt, which isn't that much, they won't have any problems servicing that. Worst case scenario, they think that they might internally restructure, their liabilities.
No, Steve, you're exactly right. And look, they are going to do a debt jubilee, right? The Bank of Japan today owns 54% of Japanese government bonds, 74% of ETFs. At some point, they're going to get to a level of ownership of JGBs where they can just do a debt jubilee and cancel them all. So I think you're right on that. But theoretically, that should trash the yen, but it's not. So I am long-term bearish on the yen, but I would not trade against this trend right here. Draghi was a maniac, right? Do whatever it takes. And as long as he got out, the stock market dead flat, despite all his bond buying, negative interest rates, destroying the banks in Europe, and demographics really bad, turning Japanese. And Lagarde is doing the same thing, right? So I'm just not very bullish on the euro. I think it's headed down, and it's just a race to the bottom, right? All countries have got to devalue their currency to get out of debt.
Mark, do you think that Lagarde was selected because of her experience at the IMF and restructuring of debt to come into the ECB because they saw the possibility of this debt crisis and she has this type of experience?
I think that's a really good insight, Dale, and I think that's probably right. It also is, you needed somebody who literally would do whatever it takes. And we've all seen the great picture of all the world leaders at WEF, and it's all these guys huddled around this one woman. And she is the queen, right? She is tougher than all of them, and she is icy when it comes to making those decisions. So I agree that she will do what it takes to get them out of problem. So in China, China we think is playing a different game than everybody else. They're playing Go while the U.S. argues about how to set checkerboard. It's because they have a good leader, right? Their leader, way better than our leader. He thinks in, 30-year increments. And I love that, back in the 1990s, they had this goal. They wanted to have a harmonious rise. And it sounded so non-threatening. And, today, over the next 15 years, they want to have a modern socialism economy. But by 2050, right, they want to be, a global superpower. And they're going to get there. So, when Chinese equities, again, get to this bottom line on the right-hand side, usually good things happen. They got there. Good things have happened. Emerging markets, we think are actually going to outperform for a while here. Yet the rest of the world doesn't think so. More people sell in emerging markets than U.S. But here's the thing. Since the corona crisis started, Chinese equities are basically back to flat. And that trend on the right-hand side, again, looks really strong. And if we take the 200-day, I could get very, very excited about A shares in China. So remember the golden rule, real assets were very cheap. Money printing is really good for gold. That's not telling anybody on this conference call that doesn't know. But here's the interesting point is the Dow in gold terms was back to the same level as the Great Depression. So we're going to talk about the Great Depression a lot over the next few months. And I think that's kind of where we're headed. Gold line has outperformed equities a lot. And when gold and bonds outperform equities, usually forward equity returns are low. So all this talk about forward equity returns being high, I don't know what they're looking at. So mining stocks are even better. We love the mining stocks, GDX and GDXJ. And again, those.
Yeah, we were talking about this breakout, Mark, and I was always taught that the share should lead the underlying commodity, and they're doing this for the first time in a while.
Yep. And you guys were talking before I came on about why Bitcoin went down in March and whether it was correlated. And why did gold stocks go down in March? Look, in a liquidation, not a normal bear market, but a true liquidation where margin calls are happening and people are being forced to sell. You don't get to sell what you want to sell. You sell what you have to sell. And that's why everything correlated short term to the downside. So now let's get to Bitcoin. So we're in what I call the fiat fiasco. So it started in 1971 when Nixon took us off the gold standard. The currency has been collapsing ever since. That's why things cost more today in nominal terms, and why people get fooled by nominal increases. So we don't think that Bitcoin itself is so awesome. We think that the fiat is being destroyed against it. So look, we're in a parabolic growth phase for Bitcoin. Why? Because of adoption, right? There are now 3 million people who have more than 0.1 Bitcoin. So that's up every year, every quarter, every month. It just goes up. So adoption is following the S curve on the right-hand side. A parabolic nonlinear regression model predicted, and this was from 2014, predicted that we'd hit $10,000 in 2017 and $100,000 in 2021. We did hit $10,000 in 2017, and we will hit $100,000 in 2021. Why? This is really important. This is called stock to flow. Scarce assets outperform everything else. Gold is the scarcest asset until Bitcoin. As of 2 weeks from now, Bitcoin will become the scarcest asset in the world, meaning
the halving.
Its flow, because of the halving, its flow will be lower than the incremental flow of gold onto the stock of existing gold. So Bitcoin becomes a better version of gold. It becomes digital gold. And so it tells us it's on a path. Now, if you overlay the stock to flow model on this parabolic regression, look what you get. You get $100,000 in mid-2021. Pretty interesting. So from a statistical, and unfortunately I didn't update this morning, I should have, but we were at 7,300 a couple days ago. We needed to get past the 200-day at 8,000. We zoomed right through that this morning. We're at, I think, 8,150 or 8,200. So the fact that we have broken the 200-day from the bottom with authority, I think we are back in a bull market. And look, I think prices could get really, really positive, really, really quickly. So Steve, to your question about diversification, why it matters. Look, if you look at the correlation of Bitcoin to stocks and bonds, it's 0.15. It's the lowest correlation asset. And that's not over a week or a day, but over long periods of time, over the past 5-6 years. And if you added 1%, okay, so if you took a 60-40 portfolio and added 1%, your return goes up by about 30%. Your volatility stays the same, so your Sharpe ratio goes up. If you add 5% over the last 5 years, 5% Bitcoin, just take 2.5 points from stocks, 2.5 points from bonds, you actually doubled your return. That's pretty incredible. And it's because of this non-correlation. So there's no question that on Black Thursday back in March, everybody was forced to liquidate their Bitcoin just like their gold, just like their gold miners. But going forward, we think that low correlation will come back and continue. So that's all I got. And
we have a few questions.
Yeah,
Mark,
first of all, since you finished up with Bitcoin, I don't want to give you some of the counter arguments. I have to tell you, though, that I'm so desperate with the fiat system that we currently have that, I can't exclude any possibility. I mean, cryptocurrencies might actually work. I've asked you in person, so I can now ask you on the webinar. We would love to have you on a live debate with Peter Schiff because
love it.
You have more or less the same ideas about the economy and you see the same type of problems. The main difference being how the two of you see the future unfolding having to do with the monetary system. I mean, he believes we're going to go back to the gold standard. You believe that we're going to evolve to, some type of a cryptocurrency system. So
Bitcoin standard.
Backed by gold, maybe.
Absolutely.
Maybe backed by gold.
And here's the crazy thing. I would love to do it and happy to do it anytime. I think Peter's a good guy. I don't have any ill will or animosity towards him. I think he's wrong about Bitcoin. I think he's been wrong for a long time. And yet, to your point, we're really not that different on most of our other beliefs. So I would love to have that conversation and happy to do it anytime. I know he's going to be on later in the webinar, but if you want to, pull us both together back at some point, I'm happy to do it.
Okay. I'd like to ask this one question from someone who's been following you for a long time, Mark. He goes, "Hi, Mark. I'm an astute follower of your writings and webinars for years, and I had one question that I wanted to ask. You and others have referred to the next recession possibly being severe enough to take us into a Hooverville-type depression, but there were some specific factors that propagated the depression, namely poor fiscal monetary choices by the government at that time. We are not seeing that today. The Fed and Congress have been incredibly stimulative past few months. Doesn't this limit the probability of a longer lasting slowdown like we had in the 30s? If the dollar weakens enough, that should stabilize growth. No?
Look, it's a really important point, and it is true that there have been some things that the government has done that I would argue are antithetical to the 1930s. Unfortunately, I think they've actually done some things that are very, very similar to the 1930s and could exacerbate the problem and make what is a garden variety recession into, as Nouriel likes to call it, the Greater Depression. So I won't argue that the monetary response has been large, but the monetary response was actually reasonably large in the 1930s. They cut interest rates to zero. They started QE. QE was actually invented in the 1930s. It didn't start 10 years ago. So QE, they tried it. Then in 1937, at the depths of the Depression, or towards the end of the Depression, they tried to go off, at the depths of the Depression, they tried to go off QE and tried to raise interest rates from 0 to 25
like we
basis
did when
points.
we were doing QT for a while?
Exactly. And they crashed the economy even more. So the other thing that we're doing is this stance on immigration, same as in the 1930s. And then finally, the tariffs, right? The Hawley Smoot tariff bill was what really plunged us into the depths of darkness. Now, on the fiscal side, they pulled out the bazooka and they put some money that theoretically should be, stimulative. But the problem is, at least at first blush, a lot of that money isn't going to good places. It's going to the wealthy, and the wealthy don't put the money back into the economy. They don't spend it. They save it. They invest it. So that doesn't help. You look at velocity of money. If you look at Lacey Hunt's work
Yes.
from Hoisington.com, velocity of money keeps contracting. And the real problem, and this is the biggest problem, government spending has a negative multiplier effect. So every time the government spends instead of the private marketplace, we get a negative implication on GDP growth. So I actually am not sure that the response by the government, both monetary and fiscal, is going to turn out to be as good as people think. Now, it's possible that I'm wrong and the questioner is right. It's absolutely possible. I just think it's not probable because of all the other bad leadership decisions like tariffs. And let's just look at global trade. Global trade is collapsing, absolutely collapsing. And this response to coronavirus, now we didn't even get into the whole thing of, look, the cure for coronavirus is way worse than the disease. The disease is really not that bad, right? It's a normal viral threat. We've faced viral threats for thousands of years and we're still around. We're going to be around after this one. You know, people tried to call it the plague. Those people should have their tongue cut out, right? The plague killed 42% of the population of the world, 42%. Okay, then they say, well, it's like the Spanish flu. No, Spanish flu killed 3%. COVID is somewhere between 0.002% and 0.003%. It's just not a big threat. And yet we've shut down the global economy for no reason that I can think of. In fact, the challenge is we've actually reduced our ability to create herd immunity, and places like California, which probably had the virus in November, actually built up a lot of herd immunity, and they've got 1/10 the number of cases and fatalities that the East Coast has. So there's no clear evidence that what we did was right. And there's a lot of evidence that says maybe what we did is going to have long-lasting implications and drive us toward that Hooverville outcome.
Well, what we did that was right was having you kick off the summit, Mark. Thank you so
thanks,
much.
Guys. Look, I love being with you. I love your show and the process, and I applaud you and commend you for getting thousands of people to get together on a Wednesday morning and talk markets. So thanks for having me.
And you could find Mark at Morgan Creek Capital Management, at Mark Yusko on Twitter. Thank you so much, Mark. I appreciate you being here and edifying the community during the summit.
All right.
Take care,
thanks,
my
guys.
friend.
Be well.
Bye-bye,
Enjoy the rest of the day. All right. See ya.